It's 7 o'clock now. Good evening, everyone. It's time again for our investment discussion group. Before we start, let me first give a brief introduction of Kristen Jacks, our speaker. Kristen Jacks is a financial educator, author, and a founder of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and Mutual Fund magazine before becoming a writer and a speaker. Her new book on investing is lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. Today's topic is your investment checklist. Now let me turn the screen to Kristen. Thank you, Kristen.
Thank you, Young, and thank you to Greenwich Library. They are so generous with their funds to allow programs like this, and I just love doing it. So, and welcome everybody to the Investing Discussion Group. This is season 3. So if you're new, did you know that you're part of season 3 of the Investing Discussion Group? The theme this season is As You Requested. So Young and I spent a lot of time last season asking people what they most wanted to hear about from us. And we spent all summer strategizing and looking at what people had requested and trying to drill it down to kind of like what was the commonality, what were people saying? And it seemed to be, the economy. People would really like to better understand how the economy is impacting investments day to day. Taxes is always a big issue. The tax consequences of investing, hopefully how to lower taxes legally. Asset allocation was a big one, saving for college, and then also like all the behavioral stuff. The psychology of money was one of our big, most popular webinars last time. And so that's why you sort of see this like cognitive bias icon down there, because people are really interested in sort of like the mindset and their behavior and the psychology behind investing. So welcome to season 3 and welcome tonight. If you are interested in any of the past seasons, we've had so many great webinars on, like I said, like the psychology of money was one of our really popular ones. What your financial advisor isn't telling you was really popular. We drilled down into like specific things like bonds and stocks and things like that. And all of those webinars live on the Greenwich Library YouTube channel. Maybe you didn't know Greenwich Library has a YouTube channel, but they do. And it's very easy to find if you go to YouTube and in the YouTube search bar, you put in Greenwich Library. What will pop up, one of the things that will pop up is sort of like you'll see the Greenwich Library logo. So you'll see the white background, the green book, and the white tree inside the green book. And if you click on that, it takes you to the actual Greenwich Library page. And in the videos section, you'll see all of our past webinars. And today we are doing your investing checklist, and then planning ahead in December, because we meet once a month, we are doing, we jokingly called It's the Economy Stupid. So that's when people were asking about what are the economic indicators like a jobs report or an inflation report or housing starts or consumer sentiment, all these things you hear about in the news, but it's like, well, how important are they relative to each other? Do they have to happen in some combination? What does it all mean? Should I react? Should I just sit tight? So that'll be a fun one. We've never actually tried to tackle that one before, all the macro stuff. So that'll be really fun. That's in December. Okay, so tonight, actually one quick follow-up. The very last webinar we did, which was super popular, was all about asset allocation. And we took kind of a unique angle. We looked at the biggest institutional investors like Harvard and Yale and big pension funds like the state of Wisconsin pension fund. And we looked at how they invest. Now, of course, since they're institutional and they can put like $20 million to work, they, with just one group, they're going to be doing very, very fancy things with hedge funds and stuff like that. But it was also just interesting to kind of see what they're doing. Like, are they in stocks? Are they in bonds? When they're in bonds, like, how do they drill down to the different credit quality, right? Like, I thought it was fascinating to find out that, conservative pension funds are actually in, sort of non-investment grade bonds, which is sort of shocking. So, it's like, if they're willing to do it, maybe the rest of us shouldn't be so scared, that like, if you look at different bond ratings, like they're under investment grade, but they're not well under investment grade. So that could even give you an investing idea, try to figure out what they're doing and see if you would be interested. And then, of course, they're doing a lot with real estate and private credit and private equity. And more financial advisors are figuring out ways to give regular investors access to private credit and things like that. So it's really, really fascinating. And also, asset allocation is such a big part of investing that, of course, we would normally cover it tonight under the investing checklist. But since we just did a huge webinar on it, and that webinar lives online, I'm just going to direct you to that because we can't improve upon it. And I don't want to waste any time tonight since we just did that topic. But of course, normally asset allocation would be a big part of your investing checklist. So go ahead and check out the asset allocation webinar on the Greenwich Library's YouTube channel. Okay, and then quick disclaimer, this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investment strategies mentioned in this discussion group are recommended. Before making financial decisions, you are urged to consult a wide array of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay, so your investing checklist, what to cover. Vast topic, right? I mean, there are just so many things that we could be talking about. The language of money, all different sorts of investments, bonds or stocks or commodities. We could talk about the different sort of tax shelters like IRAs and Roth IRAs and 401ks and things like that. We could talk about investing in your home. I mean, real estate's still a big part. Some people would love probably for us to talk about crypto. There are even things like, what to look out for, like fees and things like that. So there's a lot of material. But since I wrote a book that was much more so for beginners, but like a book to sort of hold your hand and help you get comfortable with investing. And I spent so much time trying to organize that book and trying to think of like, what can be sort of ignored, what can save for later, what is super important. I think I have some insight into like, what is the best use of our time tonight? And this is what I came up with. So to me, the best use of our time, first of all, it's like, should you even be investing right now? I mean, markets are at all-time highs. And certainly if you have debt, like there's just that obvious question of like, should I be lowering my debt or should I be investing? Some of this has to do with whether or not we're talking about like a lump sum investment, like you got a bonus at work, or maybe you got an inheritance or things like that. If you're trying to put like a lump sum to work versus if you're just chugging along, participating, every other week in your 401k, like don't derail that. But especially if you have a 401k match. But if you're talking about like putting money to work, or maybe you just sold, a summer house or something like that, where you really have some, a good chunk of money you want to put to work, is like, is it a good idea when the markets are at all-time high to just think of investing, or should you seriously consider lowering debt? There's also mistakes to avoid. Over and over again, we hear the same thing about like what the experts say we're doing wrong, and what the academics say we're doing wrong, and it's based on their research and their observations. So let's get those mistakes out of the way. We don't want to slow ourselves down with the obvious mistakes. There's also the vocabulary around investing can be intimidating, but once you know that it's supposed to be that way, I think that's sort of helpful. And also, when we get there, I'll give you some instruction on how to get just from me a chapter of my book for free that just kind of walks you through, it's sort of like the 15 terms that if you know these, you're going to be fine. You're going to be like, 80% of the time you're going to be fine. Then there's the tax consequences of investing. Impossible to cover all of them, but very important to talk, like sort of the big themes in terms of tax consequences, and just alert you that you should always be doing your research on tax consequences. We're going to talk about risk, time horizon, and diversification. Then I want to talk a little bit about the passive versus active debate, because I think that's getting a lot of airtime now, as though like, you should only ever be investing in index funds. I think some of the research, the most famous research, is being sort of misrepresented and misused, and as though you can never beat the market and things like that. So we'll talk about that. And then finally, who can you trust? If you really want some help, anybody can say they're a financial advisor. There's actually no securities law against having the title financial advisor, even if all you've done is taken one weekend course in insurance. In fact, a lot of people who are only selling insurance call themselves financial advisors, which can lead to problems. So this is what I got. This is to me, the best use of the remaining 80 minutes we have. And hopefully you will all get a lot out of this. Okay, so should you invest or lower debt? Like I said, if you're just participating in your 401k every other week, I'm not saying like, unplug that. Most likely keep that going unless you have serious credit card debt. Certainly if you are your employer is matching your contributions, you definitely keep that going. You can't beat 100% return. But how else to think about this, especially if you have a lump sum from the sale of some asset or a gift from, who knows, or, a bonus, things like that. So what I like to do is, let's look at some of like the crippling debt that can be out there. So the image that's kind of gray, that's actually my own credit card statement, and I never carry a balance. I think that particular one is like my Home Depot card, but if you read the fine print, you're at almost 30%, 29.99% annual percentage rate. That is shocking, shocking interest rate on, and for anything, for any kind of credit card debt. And I think Home Depot is pretty common. I don't think that they're unusually high. So definitely, take a look at your credit cards and don't even accidentally carry a balance. It's just so punishing. Then I went on bankrate.com. It just kind of current, for people who want to do personal loans, maybe to consolidate credit cards and things like that. And this just takes my breath away. I mean, to have sort of the worst case scenario be 35.99% interest rate, annual interest rate, it's just shocking. But even, getting just a simple car loan these days. I mean, car loans are at 7%. So not all. I mean, if you have fantastic credit and you choose a relatively short term, I mean, there are all different variables here, but even a car loan, it's like you kind of have to ask yourself, like, how am I going to do in the market with an investment? And people tend to exaggerate how much they can earn year to year with investing. So I just wanted to take a look. So this graph, hopefully it's pretty easy to read. It's, what was the S&P returning each year? And this is taking not just the gains in the market, but if you're in the S&P 500, a lot of those stocks in the S&P 500 pay dividends. So it's the combination of the dividends you're receiving if you own the S&P and the gains of the S&P. And people tend to have sort of this bias of thinking like, stocks are usually doing well and they're, investing is usually a good bet. But certainly you can have back-to-back years where you're losing money on a percentage basis. So in 1974, 1973, 74, there were these back-to-back years of pretty substantial losses. So hopefully you can see on this graph that like, in 73, the market lost more than 10%. In 74, the market lost more than 20%. So, if you're sitting there and it's like you have $1,000 and first, you could get whacked with like 10%. So now you're down to $900. Then you get whacked with another 20%. So now you're down to like $720. I mean, wow, like over a 2-year period, you had $1,000 and at the end of 2 years, now you have $720. How does that feel? How does that feel when you're carrying debt, right? So we always have to remember whether it was, 1973, 74, or it was the late 90s. In the late 90s, so end of 90s, beginning of 2000s, like was catastrophic. I mean, you had 3 years in a row of losses. Obviously, the great financial crisis, there was an extreme loss. So losses do happen. And It's bad enough that they happen, but if you're carrying all this debt and instead of paying down the debt, you're running into these losses. So it's like you're accumulating more debt because of the interest rates, and you're losing the money that you set aside for investing. So certainly the conservative approach is to always, always, always pay down like what we consider like the bad debt, the high interest rate debt, and don't assume that the market's going to go up. So those are the assumptions I'm making, that you are financially ready to invest because you've gotten rid of your bad, high interest rate debt. You have adequate savings for an emergency. So like if your car breaks down, you're not just throwing down the credit card, creating new credit card debt. And also please be properly insured. I mean, you have the health insurance, I even just for my house, after all the horrible things that happened with the hurricanes in North Carolina, I was like, I just called up the insurance company and said, you know what, how much is flood insurance? And I was so surprised. I got $250,000 worth of coverage for $780. And I thought, why didn't I call sooner? It's just easier to sleep at night and just realize like insurance, there's so much out there, especially like life insurance, term life insurance for younger people is so inexpensive. And it's just make sure you're ready to go, you're ready to invest, because you've covered your emergencies, you don't have credit card debt, and you're properly insured. All right. So now we've decided we're ready to invest. We don't have the bad debts. We've got our savings, we've got our proper insurance, and maybe we even have this lump sum, right? Because of a bonus, because of the sale of a summer house, or even the sale of a car, who knows? Maybe we got a gift. But what are the mistakes to avoid? And some people don't know this. I mean, it makes sense once you hear about it. But let's take like probably one of the most influential investors of all time, not Warren Buffett. Everybody always thinks it's Warren Buffett, but David Swensen, who ran the Yale Endowment, he kind of revolutionized institutional investing. And he was so thoughtful and smart, and he really introduced a lot of these concepts of like getting into like the private equity and the private markets and things like that. But he rarely gave interviews, but he was on NPR before he passed away. And Chris Arnold asked him, is there this kind of biggest mistake with investors? And he said, it's definitely performance chasing. It's, you start to pay attention to something because you're hearing that it's going well, whether it's a particular, back in the day when mutual funds, had so much more sway, so much more power. And you had like the Fidelity Magellan Fund, and you had like Peter Lynch became a celebrity because he ran the Magellan Fund. People would start to pile in to investments because they heard that the investment had done well, that, a certain mutual fund had done well. People piling into Bitcoin, any kind of cryptocurrency, just when, it first came out and it raced ahead and people had no idea really what it was, but they were just kind of piling in. That might seem like a good idea considering Bitcoin is way, way up, but it crashed two different times. Over the last 10-year period, it's had like 70% decline. So when people jump on the bandwagon, it can be, really, really dangerous. I always like to mention Cliff Asness because he's such a Greenwich guy. I mean, AQR is right here in Greenwich, sort of a famous Greenwich hedge fund guy. And he agrees that, one of the biggest mistakes, and that everybody does it, is chasing performance. So, if you're going to write down, the first thing in your checklist is like, I will not chase performance. I will not pile on because other people are piling on. I will not hear that something's a hot investment and start to participate. Do not do it. It almost always ends in tears, almost always. And then, even like on any kind of, podcast, or if you're just like on the web or listening to podcasts or things like that, even they say like, it's like this oblivious investor. The post is a simple one, no math, no graphs, just a warning, the investing error I see committed most frequently is chasing performance. So it was not hard for me to pull from 3 different sources, like this is the number one mistake. So on our investing checklist, there will be no chasing performance. We do not get into investments just because we've heard that they do well. I mean, it's one thing to go to a restaurant that gets a great review. That's different. But when you start piling into an investment, you have to realize that that's driving the price up. And by the time you hear about it, probably it's later than the really savvy investors. And that has driven the price up. And now you're getting in probably at expensive levels. So just be careful. And then we get into the whole behavioral side, right? So this is the behavioral side of investing has become a real hot topic. And I picked 3 different Nobel Prize winners here just because all of their work is in the behavioral side. And they are trying to, let you know that instead of being, I guess previously, economics, the whole study of economics was based on this idea that people are rational, that they are rational actors and they're going to optimize, in some kind of marketplace in some rational way. And so, when you go to pick investments, they're the same person who's being rational about like buying a car or a loaf of bread or whatever it is going to be super rational about buying an investment. And these guys and others have really disproved that idea. And within behavioral economics, there's a lot of emotion, there's a lot of irrationality. And in fact, how we behave and the mistakes that we're making and the biases we have actually, like, there are patterns, and these patterns have been identified. And so you can at least make sure and if any part, any one of these slides is really interesting to you, just take your phone and like take a picture of it, because I actually don't share my slides. I mean, you can go to the YouTube. This will eventually be on YouTube and you can watch it there again. But, feel free to just like take a picture or whatever, if you're, or write down quickly the different biases. But here are just some of the big ones, like the home country bias, the recency bias, action bias, overconfidence, and loss aversion. These are very well documented, very well studied by academics, and trip up investors all the time. So, for example, I love this graph. Fisher Investments. I actually pulled this off of a Fisher Investments document, and this is so interesting to me, right? Like, as Americans, we usually think, like, we're going to think of the top 5 performing stock markets in any particular year, you would assume that the US is like first or second. At least I would. And no, like, I mean, Austria has the best performing stock market in 2021. Who would have guessed that? Then it was Denmark, then it was New Zealand, or previous to that, it was Denmark. Previous to that, it was New Zealand. Previous to that, it was Finland. But here are all these countries like, Ireland and Hong Kong and Canada, and all of these countries that actually have really, really impressive gains and really impressive stock markets. And we're not factoring them in, we're not even thinking about it. And especially in terms of like risk and diversification, it's like, of course you should be looking beyond your borders and things like that. So I thought the home country bias was really interesting. And it's true of every investor in their own home country, right? So the people in Ireland invest too much in Ireland, and the people in Austria invest too much in Austria. I mean, people outside the US have a tendency more to come to the US than we have a tendency to go to them. But it's a very, very prevalent bias. And it really pays to look elsewhere. It really pays to be fully diverse and like have emerging markets funds and, just pick your, pick your theme, right? I mean, it could be like an Asia fund or something like that, but get beyond our shores. So that's one, home country bias. Recency bias could really, really be bad, considering the market has done well for the last almost 2 solid years now, because we're almost done with 2024. So I have a friend, I will not out him, but he got an inheritance, and every day it seems like I'm trying to convince him not to take a lump sum and throw it right into the market because, it's just, things have been good. And companies like Apple and Nvidia and Meta and Amazon, I mean, of course, those are good companies. It's just that valuations right now are so high and those stocks could reverse badly. And it's because of, I think, recency bias. And we haven't had a bad year since 2022. It's like people have short-term memories and they kind of remember how bad it can get. And it can get really bad. Like, let's remember how bad it can get. So obviously not financial crisis bad. Like, hopefully that's a once in a lifetime thing for us. But even in 2022, you had like an almost 20% loss, right? And like, that could be really yucky. You get some lump sum investment and then you get this 20% loss. And that's a diversified loss, right? So if you have like single stock risk, really concentrated risk, you could get into, 30% losses, like no problem. So just be careful with recency bias. Recency bias just meaning that whatever is most recent feels most real and most likely to continue. So let's not do that because that could really get you into some trouble. Action bias is so interesting. In fact, John Bogle, who started Vanguard and pretty much invented the index fund, he had this expression, don't just do something, stand there, right? So instead of like, don't just stand there, do something, it was, don't just do something, stand there, because the investors all the time are taking action that they would have been better off if they didn't react. And whatever they were invested in, as long as they made a good decision initially, they weathered the volatility by doing nothing. Usually it's much, much better to do nothing. And people who trade too often usually have worse results than people who just let their money sit in the investments that as long as they, chose like good, sober investments to begin with. So we just, as a species, have an action bias. So this has just been well documented that in interesting ways, like apparently, even if you're a soccer goalie, that a soccer goalie will almost always what are those, they call those kicks, those penalty kicks. The goalie's either going to jump to the left or to the right. But apparently the research shows that they would have been better off if they just hadn't moved. If they didn't, I mean, obviously move some, but like don't make a leap to the left or a leap to the right. Just stay kind of dead straight. But it's hard to do, right? And I don't know that anyone's interviewed these goalies, but they could also feel like, well, if I didn't move, maybe the crowd would think I wasn't trying hard enough, or, but we definitely have sort of this primal evolutionary need to take action. Very hard for us to just remain calm and do nothing. So don't let the action bias get you into trouble. So especially if you hear the market's going down, as long as you're investing for the long term and you chose good investments to begin with, and you don't need money, you didn't forget that you're going to need to pay for college in 18 months or whatever, you're better off doing nothing. Now, if you did forget and didn't realize like college is around the corner and the market's starting to go down, then if you're going to do anything, do it quickly, because sometimes markets can can go down very quickly. And so better to not have any money in the market that you're going to need in the next 3 to 5 years. The stock market I'm talking about. Okay, overconfidence, that's an obvious one, right? So if you're going to be looking at investments, I always like to say, since this is such an athletic town, a lot of people can kind of relate to who were the best athletes in high school. And I look at all the athletes at Greenwich High School because I have a daughter there. And, I wouldn't turn to any one of those swimmers and say, hey, I'll race you to the other side of the pool, because those kids are phenomenal. Like they'd be done by the time I even made it halfway. Like we can understand people being better than we are, in certain ways, in certain fields. But when it comes to investing, people tend to think if they're college graduate, if they're smart, if they're interested, that they're going to, that they're better than most, or what's that stat about, like 80% of people think that they're above average drivers. So it's overconfidence is really bad. I mean, there are a lot of people out there who are smart, who are, trying to make really good investing decisions. And, go with really good, solid investments, but not because you think you're beating out other people, but just because like the investments over time, it's going to be like a rising tide that lifts all boats. Because if you think you're beating other people, then you might be suffering from overconfidence, and you might be the patsy at the poker table, as Warren Buffett would say. And then loss aversion, I just threw in there because it's kind of the opposite of the overconfidence. It's kind of like the panic of, well, what it is specifically is that our losses hurt twice as, they are twice as painful as gains. So, if you put money in the market, if you put $1,000 in and you lose 200, that feels twice as bad as if you put $1,000 in and you gain 200. So, keep that in mind. Losses are painful. Make sure you're ready for losses, because you can't really invest without them. And also just keep in mind, it can be painful because if you know that ahead of time, then maybe you won't overreact and like pull your money out at the first sign of loss, because you can just understand that losses are painful. And then, you don't really want to have to sell at a loss if you can avoid it. And very often, markets recover. Okay, so those are our biases. You know what I forgot to, I thought I had I usually have a slide in here at the beginning that says, please participate, meaning you can always put a question in the chat. This is like the investing discussion group. So it's supposed to be a discussion. You can also unmute anytime if you have a question. Let me just quickly check the chat. There's one thing in the chat, but sometimes that's Young. Oh, okay. That's Young saying, please enter your questions in the chat box. But certainly at any time, if you have a question, put it in the chat or just unmute. And of course, I'll also try to pause and ask if there are any questions. Okay, so we did, get rid of the debt. We did our big mistakes. We're not going to chase returns. We're going to check all our biases at the door. Then it's time to master the vocabulary. And I so appreciated this book by John Lanchester. One of these days I should try to like find him and tell him how often he's on my slides and he's in my book. He's such a brilliant guy. And he wrote this book, How to Speak Money. And he just observed that investing is particularly difficult because words that are used in investing lose their everyday meaning, right? So like a coupon in investing, like how are you supposed to know that's the interest that's paid on a bond, right? And a hedge fund, maybe way back in the 1960s, a hedge fund usually was hedging something, but that is no longer true. That doesn't have to have anything to do with the particular investing strategy of a hedge fund. So, you can forgive yourself for if someone says hedge fund that you just don't even know what they're talking about, because a hedge fund is just kind of a shell. It could mean anything. Those guys could be doing anything there. And then even like securities, right? Like, trading securities. Securities have nothing to do with being secure, right? There's no security in the securities, because a security could be a good investment or a bad investment. It could go to zero. So the language that you're going to come in, you just can't infer, right? So if you're a very smart person, very worldly, you've gone to college, and you think you should be able to look at investing and be able to tackle it, no. I mean, if you look at a 401k menu, I actually start my book on investing. So this is my book, and the library has copies, Investing, Your Lively Jargon-Free Guide to Getting Started. I actually start the book with this fictitious person that we can all relate to, who's got her new job, and they give her employee package, and part of it is her 401k menu. And on the menu, she has to pick her investing options, but she can't decipher any of it, even though she's a college graduate. It's like, do you want to be in the JP Morgan small cap index fund? Or do you want to be in the PIMCO total return fund? Or do you want to be in the Invesco high yield fund? And the only thing she thinks she recognizes is high yield, right? She's like, okay, high yield. I know high yield's good. I know that. And of course, if you know anything about investing, high yield means junk bonds, right? It doesn't mean high yield like the way you want a high yield on your CD or a high yield in your savings account. High yield is a euphemism for bonds that are below investment grade. So when you see a high yield fund, you got to slow down and be like, wait, what am I getting myself into? This means these are, bonds. So these are loans to companies that are not investment grade. So risky companies, maybe companies that are already, have a huge debt burden or in a risky part of business or don't have enough of a track record of growth or income or anything, So the language can be very confusing, but I did in one chapter try to tackle the language just to make it like, if you just understand these terms like cap, right? Like if you see something like small cap index, it's like, do you know what cap means? Do you know why they're saying small? And do you know what index means? Like there are certain building blocks that if you understand them, you're going to understand a lot of what you're seeing. So if anybody wants that chapter for free, I just email it as a PDF. kjacks@moneyinyour20s.com. Just email me. I will shoot you the chapter. And hopefully then I do promise that after reading that one chapter, you will be able to read your 401k statement. You will be able to choose whether you want, a large cap fund or a small cap fund or a mid cap fund. You'll understand what an index is, all those things, growth versus value, all that stuff. Okay, so the language is tough, right? So you're going to have to, not going to infer anything. You're not going to expect to understand the language. You're going to understand that words, the everyday word when it's used in investing. And this happens, all over the place. Like a premium, right, in insurance is not the same as a premium elsewhere. How are you supposed to know that the premium is like the price you're paying on your insurance? I mean, this is constant problem of like, you can't infer the language. So Google it, go to so what's the one? Is it Investopedia? I think that's probably, I think it's Investopedia is like my favorite website. So, if the language doesn't make any sense, just Google it or go to investopedia.com and look it up. And, in no time, you're going to be, on your way. And certainly if you want that chapter from me, just go ahead and email me. Okay, the tax consequences of investing. Oh boy, is this serious. If you're just starting out and all you're doing is investing in your 401k, then you don't have a lot to worry about. Once you've accumulated some money outside of a tax sheltered account, it's incredible how things can go awry. So, just some of the big themes. I don't know why this is true, but if you own, let's say any investment, but you own a stock, right? And the stock goes up. If you own that and then you sell, right? So you buy something at $10 a share, it goes to $12 a share, you've made 20%, you decide to sell. If you own that stock for less than a year, I think it's a year plus 1 day, actually, technically, then what you owe on your gain is taxed at your ordinary income rates, right? So hopefully you understand a little bit about tax brackets, right? That they start out like the federal, let's just take the federal tax bracket, right? So when you're earning your income at your job, a certain number of dollars are taxed at 10%. And then the next level of dollars are taxed at 12%. And then after those first two relatively easy brackets, then it jumps to 22%, right? And that's when you really have to start paying attention, when your dollars start getting taxed at 22%. And then after that, it goes to 24%. And it keeps on going up till you get to 37%. There are some dollars that people earn that are taxed 37% just at the federal level. Then those same people still have to pay state tax. They probably, unless they live in, a tax-free state like Florida. And they might have to pay local tax. There are all sorts of things that go on. They had already paid up to a certain amount of income, Social Security tax. So it's not far-fetched to get a 50% tax rate in this country. So if you own an asset and you sell it for a profit and you've owned it for less than a year plus a day, then you're getting taxed at your ordinary income rates. Now, for young people just starting out, that's not too scary. But as you have more of an income, things get more sophisticated, or you're married to someone who has a very high income. You are like sort of one legal entity if you're doing your taxes together, and you could be pulled up into their higher tax bracket. So that's very important to consider. So you might not want to do a short-term, sale because the tax consequence might be catastrophic. So especially if you're very close, you've owned something for like 11 months and, you think it through. It's like, maybe you want to get over that like 12-month plus 1 day hump to make sure that you go into what are the capital gains rates, because almost always the capital gains rates are better. The capital gains rates are either 0% if your income is relatively low, 15%, or 20%. There is a 20% capital gains rate, but it's only for very, very high income earners. So very often, like if you're going to be at the 15% rate for capital gains, but otherwise you'd be in the 22% rate on income, that's a big difference. That's something to really, really think about. Then there are all sorts of rules, like the wash rule trips people up all the time. So if you are, let's take another stock, you own a stock, and this time the stock has had a loss. So for a very long time, a lot of us have loved Pelotons and, maybe liked the Peloton stock. But up until recently, Peloton has not been doing well. So, it's like maybe you bought it at $10 and then it went to $5 and you want to sell it. And so you're going to sell it at a loss. And of course, when you have a loss, you want to use that loss. You want to be able to offset gains elsewhere by using that loss. Well, you have to understand, like say, you love your Peloton stock, but you're disheartened. The stock has been down for so long. You just decide to sell it. Say like 3 weeks later, you regret that you sold it and you want to buy it back. Well, that's called the wash rule. So if you buy that stock back, then the loss that you incurred, you cannot realize. That loss just kind of disappears. It gets washed away. So you've got to be really, really careful that if you have a stock and you're selling it for a loss, you do not buy it back unless you're a day trader and you're ignoring all these rules, because day traders do that. They don't care about those consequences. But it could very well happen that you have the Peloton, it loses money, you sell it, you miss owning it, you buy it back, and then it continues to go down. Well, you've lost your ability, that initial loss that you had locked in that has been washed away. You can't recapture that. So you could be in real trouble of like not being able to offset any of your gains with true losses because of the wash rule, because you've lost your ability to do that. So, it's so important to have a basic understanding of tax consequences. Now, none of this applies when you're inside like you wouldn't be doing this in your 401k because your company wouldn't allow it. You're not day trading and things like that in your 401k. And also it just wouldn't matter. Like if you wanted to switch out of one investment in your 401k into another, there is no tax consequence while you're inside that tax shelter. And also if you took your 401k and you rolled it over to an IRA and you can do whatever you want, there's no tax consequence, right? But if you have a brokerage account, if you're just doing this like out, in your brokerage account, that's when you have these tax consequences. Then there are also, with different investments, there are different rules. So have always been a big fan of I bonds, and they're very easy to buy from the government. You just can go on the website and you can buy them in very small increments, and they're really nifty. And a lot of people don't know that one of the reasons they're really nifty is that, first of all, the gains, the interest that you're making on the I bonds, those gains are tax deferred. So like if you owe I bonds, you're earning interest, but you don't have to pay tax on the interest as long as you didn't cash in the I bond. So the tax is deferred. So you will eventually pay interest, but it's deferred. And that can be a really great deal for people who, especially if they're in a high income bracket, and especially if they're in a high income bracket now and they might be in a low income bracket later. But then for people who they meet a certain income requirement, if you use your your accrued interest, if you eventually use it for education, you may never have to pay tax. So there are just so many interesting tax rules out there. But how are you supposed to know? No one's teaching this in school. And when you go on the government website and you look at I bonds, it doesn't jump right out at you, all these benefits. I mean, I think it is in there. I do remember seeing it on the website, but it's like you really have to like go do some deep research to know what some of these benefits are. And there are random things, right? So like, some people like to invest in gold. And that's great, that's fine. But if you look at like capital gains rates, right? So the capital gains rates almost always are like this 0%, 15%, 20%, and 20% is pretty rare. You have to have really high income. Well, how are you supposed to know that if you invest in gold, that gold's capital gains rate is 28%? I mean, I've been doing this for a long time. I didn't know that. The entire time I was working at Kiplinger's Personal Finance magazine, the entire time I was working at Mutual Funds magazine, never heard this, but it's true. So I was actually trying to remember, if you do want to be investing in gold, it's like you do something funky. And I was looking this up. So physical gold is considered a collectible. That is just bizarre. It's not even considered a commodity. It's considered a collectible. So how can you, if you want to be in gold, not have to pay a 28% capital gains rate? And they do have this approach where I guess you're doing this through ETFs and mutual funds, where instead of actually owning the gold, you own a futures contract or an option on gold. So that way, if the price of gold moves, you capture that. But in terms of your gain, it would just be a regular capital gain and not this collectibles capital gain. Crazy stuff, right? I mean, it's really incredible. I mean, maybe one of the things is just have like your tax person on speed dial and or just always be Googling about tax rules and things like that. Really, really important to stay on top of this stuff. And if anybody has a question, please go ahead and put it in the chat. And of course, like I said, with like 401ks and IRAs, like that, none of this stuff is happening. You're not having those tax consequences, because the tax consequences come at the end when you start pulling money out. But it doesn't matter like how you've been investing and buying and selling and things like that within these tax shelters. Although it does matter, not to make things too complicated, but some people, when they get really sophisticated, if they have an IRA, they have the typical IRA that's at a Fidelity or a Schwab or a Vanguard or whatever, a typical custodian. And some people, as they've really accumulated money and they learn what the tax rules are, they know that they can start doing really interesting investing. Like you could literally buy a house using the money inside your IRA. So it's called a self-directed IRA. And so there are tax rules where you could literally take money in your IRA to buy a house. Like say you want to get into flipping houses and things like that. But if you do a self-directed IRA, there are very, very strict tax rules. So you're not going to use like a normal custodian, like Fidelity and Schwab, and those guys will not let you do this. So you have to research, like, I transfer my IRA money to a custodian that will allow me to either invest in a business or buy crypto or buy a house, they'll do all these funky things. But then there are serious, really strict tax rules. So if you decide, you want to use your IRA to go flip houses, well, then like you can't be, if you're a real estate agent, you can't be the real estate agent on that deal. And you can't live in that house. And your children and your siblings and your parents, I mean, maybe your siblings, I can't remember, but it starts getting into your family, like your family can't benefit from these things. So tax rules are everywhere. And in some sense, like it's a really cool opportunity, like, using a self-directed IRA to get into much more interesting investments. But at the same time, you have to be super, super careful that you are not going awry. And if any of this stuff is interesting to you, go into your podcast, however you listen to podcasts, and just type in self-directed IRA. And there's some really interesting podcasts about being able to do that and how you can take the money from like a normal IRA custodian, switch it to a custodian that lets you do things like this. And you can do really interesting investing. I mean, you could even invest in like a multifamily, like say like the South is booming and there's an apartment complex being built in Nashville, Tennessee, and you want to invest $50,000 in that. There are so many ways to do that now using money in your IRA, and it's all legal, but you have to know which custodians to choose, and you have to get really, really good tax advice. Okay, so risk, time horizon, and real diversification. Super, super important. Here's the thing about risk. When risk is discussed in investing, it's like the academics and things like that, the people who really study sort of the math side of investing, they will say that volatility is risk. So it certainly feels risky. Volatility feels risky. So what do I mean by that? Like, let's take, okay, Facebook. Most people love Facebook. I see there's a question in the chat. Let me just jump on that. Let's see. Could you please explain the tax efficiency of mutual funds that pay out capital gains distributions each year versus ETFs with similar investment strategies, e.g. target date funds? Oh my goodness, yes, thank you. That is brilliant question. So ETFs, so a lot of people, if someone says like, what's an ETF, they'll say like, well, it's just kind of like a mutual fund that you can trade during the day, like a stock. And that is not accurate, okay? Because there could be humongous tax consequences, like the difference because of how an ETF is structured versus how a mutual fund is structured. So, where did mutual funds come from? Okay, well, back in the day, you did not have the trading that you have now. So today you could do, you have if you have, a Robinhood account or a Schwab or a Fidelity account, and you write on your phone, you could buy 10 shares of anything you want. There are no commissions. You could create your own little mini mutual fund with not a lot of money. That was not true years ago. So it used to be commissions were very high. So to get into an investment, to get out of investment, very difficult. You had to do like 100 shares of anything. And so if you wanted to have like a nice portfolio of like 15 different stocks, you couldn't do it without a ton of money. So that's where mutual funds came from, right? So it's like you're going to buy into a mutual fund because the mutual fund is pooling all the money from all these other people, and they're going out and buying like the Exxon stock and the, I don't know, like back in the day, like what were the big stocks, the Macy's and the things like that. So they were buying all the stocks that maybe you were interested in. And so you could just give them $1,000 and they got you all this diversification. They got you into all of these investments. The problem has always been with mutual funds, especially when markets go down. So your money is mixed in with everybody else's money, right? And all of these investments are owned. And the rules of the mutual fund, they're not allowed to have a lot of cash reserve because, you know, the mutual fund has some theme. They'll say like it's a large cap growth fund, right? So they're supposed to be taking the money they get and buying large companies that are growing, right? Like an NVIDIA is a perfect example of that. And they don't have a lot of cash reserves. Well, what happens is the market goes down, people panic. Some people inside the mutual fund, they want their money back, okay? And you're pooled in with these people. So those people want their money back. The fund manager has to sell some of the securities in order for the people who want to redeem, for the redemptions. So, you know, say this really smart fund manager was in NVIDIA and NVIDIA has gone up a ton, right? Well, that's going to trigger a capital gain that gets distributed over everybody in the mutual fund, right? So you're going to have a tax consequence that's beyond your control if you're in a mutual fund in a brokerage account. Not if it's happening in your IRA, if it's happening in your 401k, you're fine. But it's just the way mutual funds are constructed that, like, because your money's pooled with other people, if they want to pull their money, the mutual fund manager has to sell. Those securities may be matured. So now there's a capital gain, and that capital gain gets passed on to you. It's going to be a tax consequence for you. Now, the crazy thing about ETFs are not the same as mutual funds. They have a different structure. So, and I couldn't possibly explain this adequately. They have oh gosh, what is it called? A creation redemption feature. Very different than what I just described, where all the money has been deployed. And in order to give, you know, somebody wants out of the mutual fund, something has to be sold, that person gets their money back, everybody else gets the capital gain. ETFs have a very different structure. So when somebody buys an ETF, if they want to sell it, that does not create a tax consequence for anybody else. So all these ETFs are mostly being bought and sold during the day. And the ETF can have the same basket of underlying securities as a mutual fund. They're just far, far more tax efficient. So, it's very hard to understand. But when people don't want their ETF anymore, they sell it, it's not creating a tax consequence for anybody else who owns that ETF. It very rarely does. I cannot fully explain that. It has to do with redemption and creation of how ETFs are put together, but it does not create the tax consequence. So almost always the ETF is going to be more tax efficient. Now, that doesn't matter if you're owning mutual funds inside a 401k or an IRA. It only matters if you have it in a regular brokerage account. I don't think I can spend more time on this. Just trust me, you know, go to your advisor, go to your tax person. They can explain it to you better. But it is true that mutual funds are less tax efficient, which is why you probably just only want to, I love mutual funds. I mean, I used to work for Mutual Funds Magazine, but you want to own them inside a tax sheltered account. Let me see if there was another question. Okay. All right. Sorry. Moving on. Risk, time horizon, and real diversification. So what you're going to find is that the volatility, so the volatility of like how the asset is being priced. So I'm just going to use Facebook as an example. Okay. So because everybody can kind of relate to Facebook, which is Meta, right? I mean, it's because they own Instagram and they, you know, so the stock ticker is META now, Meta. Well, if you've actually tracked, like, you know, Facebook hasn't changed that much, Instagram hasn't changed that much, good company, you know, very popular, whatever, that stock price moved so dramatically. I'm going to give you the specifics. In my book, I have a chapter called "Why Did That Stock Price Move?" And it talks about this sort of wild ride of, okay, so Meta, the parent company of Facebook and Instagram, climbed to almost 400 a share in 2021. By 2022, its stock was $90. Okay, so it was 400 a share. Then it was $90. Then at the time I finished writing this book, it was $330, and now it's in the 500s. But can you imagine that roller coaster ride if you got in at 400 and you saw it go down to 90? I mean, that is catastrophic, right? So when risk is discussed with, especially with stocks, risk is equated with volatility because you will have these crazy, crazy swings. Now, if you're capable of getting used to those swings, really, really seasoned investors, it's easier said than done. They say volatility is not risk. Like you can't, just because things are swinging around and they're too high when they're high, they're too low when they're low, just because the market is bipolar, you cannot take it that seriously. Because when Facebook, Meta, whatever, was $90 and it was 2022 when everything was crashing and who the heck knows what was going on. It's it's the market is so bipolar. It's too low when it's low. It's too high when it's high. I don't think Meta should be over $500 today. I think that's crazy. So the whole issue with risk is that if you can't stand that kind of those price swings, then just, participate in your 401k, dollar cost average, slowly put your money in and never look at your statement, right? Like just don't watch, because what the time horizon shows you is that usually like these catastrophic swings, over years, they get all evened out. So let's even go back to the, where's our S&P? Here we go. All right. So obviously, 2008, I mean, what a catastrophe. Like almost a 40% loss for the entire market in 1 year. I mean, that is, gut wrenching, right? And then, within a few years, everything was fine. Everything's back to normal. 2022, like almost a 20% loss. And then the next 2 years after that, it's like, oh, never mind. Did we say 20% loss? Oh, just forget it. Everything's fine now. That is what is always happening in stocks. They are so volatile. So what's the real risk? The real risk is your behavior. The real risk is that you cannot stand to see these price swings. And you're supposed to buy low and sell high. And behaviorally, we are wired to do the opposite. We are wired to be uncomfortable and slightly panicked. The longer the declines last, as that recency bias. So the longer the declines last, we're going to think this is the new normal and we should get out, while we still have some money left. I mean, we are just not wired for the volatility, but that's what you get. You get volatility. And so if you really can't stand it, then you just have to pick things that are not volatile. The classic portfolio was always 60% stocks, 40% bonds. And the bonds were like the ballast of the ship. The bonds kept things from being too volatile. It didn't work out so well in 2022 because we had interest rates rise just so suddenly, but in theory, you'll be fine. Certainly, if it really, really bothers you, then just stick to things like CDs, or whatever you're making in your savings account, or an 18-month CD is probably going to be better than what you're making in your savings account. But, just lock in that 5% gain, or buy treasuries, right? Buy things where it's you will absolutely get your money back plus interest. You control the whole process. So treasuries, it's the outcome is secure. The interest rate is secure. Everything is secure. If you can't stomach the wild ride, so only your risk profile. And a lot of people will say they want risk, that they can handle risk, but it usually you have to drill down more to okay, well, right now, your 401k statement says you have $80,000. A year from now, if it says you have $65,000, are you going to freak out? Or are you going to be like, yeah, that's fine. That always happens. I'm sure it'll be $111,000, 2 years from now. And that's probably right. But can you stomach it? And being able to stomach is really based also on having a time horizon, right? Because you have to be able to weather the downturn. So never, ever, ever be in the stock market if you need to get your money out for a down payment on a house, or you need to get your money out because at the end of the year you're planning to buy a car, or you need to get your money out because a year from now your kid's going to college. There should be no dollars in stocks that you're going to need for the next 3 to 5 years. Especially, I mean, some people say 3 years, but with the market at all-time highs, I mean, there could be such a reversal. I mean, if you look at what happened in so look at the end of the 1990s, beginning of the 2000s. I mean, could you imagine having 3 years in a row of declines? It's just so catastrophic, right? So with the right time horizon, I mean, I am curious. I actually haven't done the math. I know in the 2000s was just a horrible, horrendous decade. So wherever you were, like, well, not you, but wherever people were when they started the 2000s with their accounts, they went totally sideways. Like after a decade, there were basically no gains, right? Because of the big losses. So, wherever you were in the beginning of the 2000s, unless of course you're dollar cost averaging in, you're adding, money. But whatever you had as your base investment, the year 2000 to the year 2010, you had no gains. I mean, this happens, like this can happen. So you've got to understand that that's a possibility, and also like a wild ride in between. So, that you got to figure out your risk. Having a longer time horizon can really help weather the downturns. But, whether or not you're going to select totally safe cash equivalent investments like CDs or treasuries, or maybe you could go into corporate bonds, but only for AAA rated companies. That's going to be your decision based on your risk tolerance. Okay, let me get back to where we were, and certainly put any questions in the chat. Okay, so that was risk, time horizon, and then this real diversification, super important. I think Young's going to get sick of me using this slide, but it bothers me so much when people don't understand whether or not they're really diversified. So America's most popular favorite investment by far, the S&P 500, right? Because this is what you think you're getting. Look at all these wonderful companies. And we're so lucky to have like Netflix and FedEx and Starbucks and Kellogg's and IBM and the Hartford and Johnson & Johnson and Walmart and Visa, like great companies, right? So who wouldn't want to do this? Like, this is a no-brainer. Go into the S&P 500, get this like wonderful distribution of companies. Even if one or two of them go off the rails, there are just so many other good ones. What could be better? This is what people think they get. This is what you really get in almost all the S&P 500 investments you could go into. Whether it's Fidelity's S&P or Schwab's S&P or whatever, it's like almost all of the S&P investments are what we call cap weighted. So as a certain stock, a certain company, as their stock price increases, the way that the index is set up is that the index has to buy more of that stock, right? So as a stock gains popularity and its price increases, the index actually has to buy more of it. So in recent years, the index has become completely out of whack. And hopefully you've heard of this, that you understand that there are the Magnificent Seven that now dominate the dollars in the S&P. So like 30% of the entire S&P 500, right? So if you think about this, if there are like 500 different companies, no one company should even be 1%, right? Because it's 500, 500 companies, 500 companies, no one company should even be 1%, but that's not what's happening. You have 7 companies are 30% of the index. And you have, Microsoft and Apple and NVIDIA and Meta and Tesla, and they are dominating this investment, right? Well, these are also very companies with very high valuations. And if there is a reversal, and they're also sort of somewhat interrelated, you have like the information technology and things like that. That's a really big bet. That's a very concentrated bet. That's not real diversification. So you're going to need a strategy to fix that, right? So I'm not saying like don't ever be in the S&P 500. On our last webinar, someone mentioned that there are now ETFs that it's the S&P 500 without the Magnificent Seven. So it's like get rid of like the big boys and now get sort of back to your like more reasonable distribution of capturing those other companies. That's one way to do it. You could do, the Russell 2000. So like you're ignoring all the biggest companies altogether and you're just getting the 2000 smaller companies. You could buy a mid-cap fund. There are all different ways to, and certainly like you have the home country bias. So you could go overseas and you could do an emerging markets fund or something like that. So there are all different ways to have real diversification, but the typical S&P 500 is no longer one of them. That's kind of sad news, but true. Okay. Oh, something in the chat. Let's see what we got. Maybe do you think that the stock market is overvalued? Yes. Do I think so? Yes. No question. No doubt. How long do you think it can maintain these levels? Who knows? But like I said, I have a friend who inherited money and he's a buyer today. And I mean, this is a guy who goes out and he's like, I think I'll just take $20,000 and buy Ford. And I'm like, what are you doing? At these levels, you could get so hurt. I mean, I need to dig up. There is some research about like how bad it gets if you take a lump sum and you just put it in at the top of the market. It's like other people who've been dollar cost averaging in when the market goes down, it's like they can recover in like 2 years. But the person who put all their chips on, whatever, when the market was super high, they don't recover for years and years and years because like it can take a long time to reach that high. I mean, I really have to uncover this because I was remembering like when the QQQ, like the NASDAQ 100, it hit its all-time high, I think, what was it, like March of 2000 or whatever. And I think it didn't get back to its high for 16 years, right? So whoever got in at the high had to wait 16 years to just get back to that level. The Japanese stock market, I mean, what was that? That was like a 25-year wait to get if you only got in at the high. So do I personally think it's risky? Very risky. However, they also say you can't time the market. So if you're chugging along with your 401k and every 2 weeks, you're going into your investments, I really can't argue about like, cut that off because I'm not exactly sure, nobody knows when the market would go down or when it would recover. What can very often happen is that like, say somebody gets out today, but then the market goes up another 10% and that takes a year. Well, okay, then they missed that, but then they don't know really when to get back in, but then the market goes down 20% and they're feeling good, but then the market turns around and goes right back up again. It's very hard to figure out. So this is much more of a like, be cautious if you have a lump sum. And that's why if you do have a lump sum, be looking at your other cash needs, be looking at your debt. I mean, that's when it really gets into like, when the market's this high, okay, obviously you're not going to do credit card, personal loan, things like that. But what are your student loans? What are your car loans? What are your cash needs a year and a half from now? So just take any kind of lump sum, put in an 18-month CD for anything that you're going to have to pay a year and a half from now. So that do all of that before you consider going into a market this high. Let's see, was that, I think that was the last question. Okay. I'm going to try to get the active versus passive debate. This is something that really bugs me. Okay. Okay, so let's do like a brief history of passive investing. I mean, it would seem today with like all the index funds that are out there, especially the S&P 500, that like we've always had that. It's always been that way. And then more and more you hear pundits say like, you cannot beat the market. And they say things like, the studies show you cannot beat the market. And it really bothers me because they misrepresent this one very, very good study. So there's the SPIVA study. So it's the S&P, like you take the S&P 500, the S&P index versus active management. Active meaning like, there are fund managers picking stocks and stuff like that. So SPIVA, so S&P index versus active. And people will misrepresent the study and they'll say like, well, even the studies show that you can't beat the market, that like, if you take these fund managers that are buying the different stocks, that they don't do as well as the index, like, and they'll say like 90% of the time, always, whatever. That is a complete misrepresentation of what the SPIVA study shows. So if you want to be in something actively managed, like there are certain fund companies that you admire, especially in like less obvious areas of the market, like if this small cap, like a fund that only looks at like upcoming companies that are small, or something that only looks at emerging markets, like, or only looks at China, or only looks at India, or only looks at Korea, that's not an index, right? They're not just like taking the average of everything that's out there. They're not just like grabbing every stock in India that has this value or above and creating an index off of it. They're doing, real research, and they're picking one thing and not another. So they're being active managers. The research does not show that active management, always loses. In fact, in a crisis, like when we had 2008, active managers did better than the indexes. So that's just a fact. In bond investing, active can definitely do better than just buying like index bond funds. What happens is, and it's a little bit because people chase returns, when you have like successful funds, and then people see that they're the active ones, people see they're successful, they pile their money in. As the fund gets larger, it's hard for that success to be sustained. And so then they start to do less well. So what can happen is like the same fund that's been delivering really good results gets too much money, gets too large, starts to have poor results. So it's very hard for a winning fund to beat an index over a 5-year period, right? So that is a problem, but it's not true that, you should always avoid active management. And also, I mean, it really gets also down to fees, right? So a lot of the reason people hated active funds, especially like way back, the fees were ridiculous. You could have like a load fund, so if you started to see like no load mutual funds, and people are like, well, what's even a load? Like, why do I need a no load mutual funds? What is a load mutual fund? A load mutual fund used to be like an advisor would say, get into this fund, but there's a 5%, whatever money you were going to put in, 5% of that just goes as a commission. It used to be practices like that are obviously terrible. It's very hard for you, to lose 5% of your money just going, into a fund. So that's when active management got a really bad rep. Really bad also, like, because there'd be churn inside these funds where it would create like a nasty tax consequence for you, but they were doing it to drive up commissions. I mean, there are all sorts of shenanigans, but you do not only have to be in index funds. I mean, there are, smart moves out there, especially in less well-known parts of the market, whether it's small cap funds or emerging market or wherever, where you're within your rights to forget about passive, meaning like not everything has to be an index. Okay. Okay, whom can you trust? That is the final question. So very important for everyone to understand. Anyone can put on their business card financial advisor. We, believe it or not, with all the securities rules that we have, with all the consumer protection rules we have, there's no rule saying that, like, a professional, I mean, obviously I can't go out and say I'm a doctor. I can't go out and say I'm a psychologist and start seeing clients. I can't do those things. Anybody can say they're a financial advisor, anybody. So you have to be really careful. Very often someone will say they're a financial advisor when really all they're knowledgeable about insurance. This happens all the time. So if you think you want to work with someone to get holistic advice, that would be great. I mean, the certified financial planner, the CFP, certified financial planner, Those are great if they're real. Always check people's credentials, make sure it's real, because they have the most holistic approach. They didn't learn just investing. They really learned, like, you know, your budget, your cash flow, whether or not you have enough insurance, whether or not you should pay down your mortgage. I mean, they see like the big picture, especially if they're fee only. Those are very, very trustworthy people, because often even the good guys who are really like a stockbroker isn't necessarily bad, like especially someone who's passed the Series 7. That's a very complicated exam, so they probably know investments pretty well. But the way they're normally incentivized is, say the best bet for you with your money is to pay off your car loan, right? Or say the best bet for your money is for you to do a Roth conversion, where you pull money out of a traditional IRA and you put it in a Roth. Well, a financial advisor who's paid assets under management might not give you the best advice, and also is not a fiduciary, so she doesn't have to give you the best advice, because they get paid by assets under management. So they're not going to tell you to take your money elsewhere. So you have to be really careful understanding, even if someone's smart and qualified, how are they incentivized, right? So you want to make sure, if you can, that you're just paying a fee. You're just paying a fee for their advice. And you want to really look at their credentials. So someone can be a CFA, a certified financial analyst. That's a really terrific credential and means they're very knowledgeable about investments. Doesn't mean they're knowledgeable about anything else. They're not going to, are they even going to ask you if you're walking around uninsured or underinsured? I mean, somebody who has a lot of assets should absolutely have an umbrella insurance policy. No CFA is going to ask you that. Or I shouldn't say that. Maybe they would. Someone's like kind of been in the business for a long time, thinks big picture. But if you're going to them looking for, your investment portfolio, they're not going to talk to you about whether you have an umbrella policy or should you otherwise be paying down your mortgage, right? So you really want to investigate the credentials of the person you're thinking of using. And yeah, and hopefully they have a fiduciary standard, which, stockbrokers don't have to have that. And when I say stockbroker, what I mean is, your guy at Merrill Lynch is going to say he's a financial advisor, and he's passed the Series 7 and he really understands investments, but he doesn't have to act as a fiduciary. He has to give you suitable investments. He doesn't have to give you the absolute best for you. So hopefully that makes sense. And finally, final thought, just invest in yourself, especially if you inherited a lump sum. I mean, really, like, what is it that you could do to invest in yourself? Could you go back to school, or even something on a smaller scale, take a public speaking course, take, advanced training in Excel spreadsheets, anything that you can do to boost yourself, to boost your profile, your earning capacity. I mean, nothing beats a raise, nothing beats you personally earning more money. So, when you think about investing, think about investing in yourself, and also your health too, right? Because, how good a worker can you be if you just don't feel well? So get that health boosted, invest in yourself. And then join us for the next one. Join us in December. It's The Economy Stupid. We'll go into all those economic indicators. And yeah, enjoyed this. Any questions, put them in the chat. We have 7 minutes left. If you want to be a diehard and stay till the very end, you can. Oh, go ahead.
No. I'm just checking to see if any questions.
Yeah, anyone can unmute if they want.
Yeah, if you have a question, just unmute.
I see something in the chat. Oh, great seminar. Well, thank you. I certainly enjoyed it.
Oh, by the way, I have an announcement to make.
Yeah.
Next Wednesday at 1 p.m., we have another financial program about wills.
Oh, we mean writing a will?
Yeah.
Oh, yeah. Oh, you
Wills,
have like a
and the
lawyer
week
coming in?
and 2 weeks after that, it's estate planning.
Oh, cool.
Trust. So we have two programs next Wednesday, we have wills, and 2 weeks later, it's also on Wednesday, 1 p.m. It's about estate trust. It's about trust. So we have 2 programs for estate planning, will, and a trust.
Oh, great. We do have a question. How can we invest in overseas investments? So there are a lot of ways to do that, right? So you can, like, if you have a brokerage account, I mean, there are a lot of terrific companies that you could, like Siemens and Toyota and Shell. And like, I just, right off the top of my head, I can think of like a lot of individual companies that you could invest in, and you can just buy their stock, like right there in your brokerage account. But if you want to be well diversified, then I love mutual funds. So, there's always going to be like a mutual fund that is, for any kind of investing you want to do. So you could go to like the Fidelity website or the Vanguard website or the Schwab website, and you could look at all of their mutual funds. Now, having what we just said about tax consequences. So if that's not going to be inside of like an IRA or something that's protected tax-wise, then you might want to look at an ETF, because today, like almost anything you could find as a mutual fund, there will be an ETF equivalent. And wherever you do your brokerage, you can always lean on those people to like, kind of help you find out what your options are. I mean, it's not the same as having like a financial advisor. You shouldn't have to be paying a fee or anything. They're just going to direct you to, the ETFs and the mutual funds that are available to all their clients. But having said that, definitely check out the fees. Can you talk about the tax consequences of required minimum distributions from your retirement accounts? Yeah, I mean, the tax consequences are whatever your tax bracket is, right? So when you finally have to take required minimum distributions, it's like all the assets that have accumulated in these tax shelters, the government eventually wants you to pay tax. Like, our country has such terrible debt. Like we need some tax revenue. So you're going to be, you're required to at a certain point, and now it's gotten so late. It's
73.
like, sorry, what?
3.5, you're required.
Right, it's like 73 and a half. Like
Yeah,
people
we
have been
just
really
had a
able to.
program last week.
What? I'm sorry, what?
We just had a program last week by Julie Jason. She had a program about retirement planning. So the previous program was about how to withdraw money from a pension plan smartly. So she talked about the minimum is raised now to 73.5. And if you have multiple pension account, you need, if you reach to your withdrawal age, you can withdraw from one account 4%, but it has to be the total of all your pension accounts. For example, if you have a four pension account, total is $1 million. One account you have $250,000, but if you withdraw 4%, you have to withdraw 4%. You can from one account, but it has to be the total of all your pension.
Okay, I don't think you mean pension. I think you mean like an IRA.
I mean IRA or 401k.
Yeah, that's what you mean. Yeah. Well, in any case, in terms of what are the tax consequences, it's like that now is treated as income. So, the it's not a capital gain. It's like as you're withdrawing, now that's your income. So that like that's treated as ordinary income. And so depending on how much you're pulling out, that'll depend on what bracket, top bracket you're triggering. So hopefully that makes sense. All right, everybody.
Thank you, Kristen.
Great,
so,
great talk.
To sign up for the next program in December.
Yes, please.
Thank you. Well, I'll send the link of the video to you shortly. Okay, thank you. Bye-bye.
Bye.